James says, "Hi, Robert and Austin and the rest of the Rich Habits Network. I want to say thank you for all the videos and podcasts you put up. I've been listening for a few months now, and I've really enjoyed them. Now, I've been doing some research on investing, and I'm trying to figure out how many different stocks in my portfolio is too many. I want a dollar cost average into a lot of blue chip single stocks, but I feel like with the amount of money I'm investing every month, I'm not really investing that much into anything. What are your thoughts?" Robert, you want to kick this one off?
I would love to, because this one should literally be in the frequently asked questions on the Rich Habits Podcast website, because so many people just have no clue. They either had a broker that had them in 45 different stocks, or they had an uncle that told them they should be day trading or swing trading, and people just don't know. In my opinion, and what I do is I think for the average person, until you get much further along and much more enhanced in your understanding of single stocks and well-versed, I think 10 to 20 is a great sweet spot, because you don't want to have so many that you can't let your winners win because you have $200 in 20 stocks and 4 of them really perform well, but you're not taking advantage of this. Austin and I talk about it all the time, that you have to let your winners win. And so you want to really be able to catch the fire when you have a really good stock like NVIDIA's been, or Palantir, On Running, or some of these. So in my opinion, if you're your beginning stages of purchasing individual stocks, or even the middle stages, I think 10 to 20 stocks is a great sweet spot.
I'm right there with you, Robert. I think in the beginning, a lot of people make the mistake, including myself, of saying, whoa, shiny ball syndrome. That stock went up a bunch. I want it. Oh, someone said this stock's going to go up a bunch too. I'm going to buy that. Oh, these guys talked about it on Twitter. This person told me to buy this one, right? And you quickly realize if you've got 50, 75, 100 stocks in your portfolio, not only is that overwhelming, but 9 times out of 10, you're not even keeping up with the performance of the S&P 500. So want to just remind everyone, the only reason you should own any single stock in your portfolio is because you believe the performance of that stock over the next 1, 3, 5, 10 years will be better than the S&P 500 or whatever benchmark index you want to, index it against. So we like to say, okay, why do I own Amazon stock? Well, I own it because I think Amazon's going to outperform the markets over the next 1, 3, 5, 10 years. And so if you're thinking about building a portfolio from scratch, I totally hear where you're coming from. It kind of feels weird to I'm buying $20 of this stock and $14 of this one and whatever, because you want to make sure your weightings aren't weird. A strategy that I've used in the past is I say, okay, great. I've got all this money invested into index funds and ETFs. I feel good about that. It's time to diversify. And one at a time, I'm now going to start dollar cost averaging into a specific company until the weighting of that single stock hits my target, right? And so that target for me, again, Robert, I don't want any of these names to make up more than 3% of my portfolio.
Right.
Because if you've got 10, 20, 30, 40% of your portfolio in a single stock, what happens when the stock goes down 20, 30% because they had a bad earnings? Your portfolio crashes. And we don't want to do any of that. So I have a target, call it 1, 2, 3% of my portfolio. I will allocate new capital to that every single week or month until I hit that target, and then I'm on to the next one. So James, really great question, and we hope this helps.
Yeah, and I want to add one more piece to this. I really like where you're at on this strategy, and that is getting people to understand also, if you do own a lot of stocks, you have to always maintain and understand your opportunity cost when you're letting the losers lose. Because so many people, I'll look at their portfolios and they will have 6, 8, 10, 12 stocks that have been losing for a year, 2 or 3 years, but they never get rid of them. And they always think, well, it's going to come back because Bill or Larry said it's going to come back. Well, guess what? That is not an investment strategy. When you have a loser and maybe your thesis has changed on that loser, get rid of it, tax loss, harvest the losses, and use that money elsewhere, because you have to make sure your money is always working as hard for you as you work to get it. So keep that in mind as well as a caveat, that you don't want to just let the losers sit because you hope they're going to come back. That is not a good investment strategy.
I love that feedback, Robert.